Sometimes when there's a lot of volatility or turbulence in the stock market, you might be thinking to yourself, hey, should I stay invested in the stock market or continue to invest in the stock market? And I would say yes, by the way. And let me show you a chart here that kind of explains that, because it kind of thinks about, what if you missed the 6 best days of the stock market? Would that matter? Think about it. You're out of the market and you only missed the 6 best days. What happens? I'm going to show you a chart, and you might be surprised by that. So this is a fascinating chart by Fidelity. And oh, by the way, in the description below, I have courses and free courses and stuff, and do hit the subscribe button if you like this kind of stuff. So timing the market is hard, so this is an advantage where, even when markets are down, to keep putting new money in and buying stuff low, and then hopefully they'll go back up. But what if you missed the best 6 days? So it's a little bit dated, but this is going from January 1980 to March of 2021, just as far as this research on this slide. And it shows the hypothetical growth of $10,000, right? So if you invested in that time period, which is like a 41-year time period, if you're invested in all the days, you never pulled your money out, you would have, that $10,000 would grow to over $1 million, right? Quite a bit of money, right? And this is the source, and this is Fidelity, by the way. But let's say I missed the best 5 days. I just missed the best 5 days. Well, I would be down 38% than if I was invested in all the days, and I'd be up around 650 or whatever. And if I missed the best 10 days, I'd be down 55, or I'd have to 55% less. Best 30 days, down 84%. And if I missed the best 50 days of every year from 1980 to 2021, so this is for every year. It's not the 50 days for the whole time period, but every single year, 1980, 50 days, 1981, 50 days, and so on, I would have 93% less than if I just stayed fully invested. And that's why I didn't know this at the time, but I've always stayed fully invested. In fact, when markets are down, I try to tend to buy more. And it turns out that was a smart thing to do, because those best days are the ones that can make the real difference for you. So we hear folks that really struggle is where they were in a market goes down, they pull their money out, and they, in fact, sell low or sell a loss, and then the market rebounds, and then they get back in at a higher point. And, they suffer some losses and stuff from there, as opposed to maybe sticking it out. So if you want to do the buy and hold strategy, I want to buy and I want to invest, and I want to keep investing periodically from my paychecks or every week or every month, and buy and hold for long periods of time. Well, to do that strategy, you got to do the hold part, even when times are bad. Because if you miss the best 5 days of a market, or the best 6 days or 10 days of a market, you're really hurting yourself. Now, the one thing to take away from all of this, even if you miss the best 50 days, you still got more money than the original $10,000 you invested in this example. Just it would be a lot less. So I'd encourage you to invest as much as you can, set up some automatic recurring things from your check to keep investing, and then stay invested, particularly if you're going to be a buy and hold investor, to stay in and stick through the whole thing. If you're a day trader and all that, well, then you're actively trading constantly. This may not apply as much to you, but if you want to be more simple, buy and hold, and proven strategy with buy and hold over long periods of time, I hope you enjoyed that chart, and do encourage you to do that. All right, hope this was a good video for you. If it was, hey, don't forget to hit that subscribe button. Check out some of the other videos we have as well.